Wall Street's growing interest, some might debate that, in impact investing has drawn scrutiny from the SEC, which is calling for the creation of ESG standards. It's kind of funny. On CNBC this week, SEC Commissioner Hester Peirce voiced her concern.
The notion that we can come together and we can get our regulator to focus on an amorphous set of qualities other than the long-term financial value of a corporation, I think we're fooling ourselves.
Join us now, Dan Gallagher, former SEC commissioner and now a partner at Wilmerhale and a deputy chief of the firm's securities department. So it's all fine and good if people want, if they have their own sort of values and interests, and it's okay that they could invest in a fund that reflects theirs. In this polarized country, I could certainly see one fund that invests in something, avoids defense stocks. I could see another fund that caters to people that want to go into space and want our aerospace companies to flourish, or want Patriot missiles funded. I mean, I could see, and you say that's fine, but you just want disclosure that they may not do better than other funds, or what's in them?
Disclosure of how you got there, how the investment choices were made. Is it understandable to the investor, how this so-called ESG product was put together?
I mean, right now it's just kind of I view it as kind of a gaffe for mooches. I think for people that are not that bright about what they're doing, right?
There is inconsistency. It's truly apples to oranges right now, and I don't think there's a call for the SEC to set standards. I think there's a recognition that there are no standards, and there's a concern, as evidenced in that Wall Street Journal article, about disclosure to investors.
Okay, but you pointed out they don't do as well.
Well, no. What I pointed out, and I wasn't the person who pointed out, there was a consultant that looked at, I think, CalPERS decision years ago to no longer invest in tobacco companies. And what the consultant decided or determined was that it is possible, given what they ultimately invested in instead of tobacco, that they would have made $3 billion more had they actually stuck in it. So I think there's actually a reasonable question to be asked about all this. The question I would ask Dan is slightly different, which is, let's say you're creating a ETF or some kind of fund and some kind of index that eliminates coal-oriented companies for whatever reason. Some people would call that ESG. Joe has an opinion that coal isn't problematic.
Right.
Look, is it the issue of sort of how they decided not to? So what do you want to know about why they decided not to invest in coal?
Well, how did you get there, right? How did you get to the decision that this is an ESG?
Well, but that's my question. That's my question. So let's say, and I'm making this up, let's say T. Rowe Price says, we've looked at 5 studies. The 5 studies say that coal creates more CO2, and that CO2 is a problem. Joe Kernan, as you know, has a different view around.
I've heard that
around that and its relation to CO2.
Yeah.
And so, who's study? I'm not saying whose study is right. I mean, we can all determine. We can all make our own judgment about that. But all you want to know is that they looked at 5 studies.
So as long as the asset managers are doing their work consistent with their fiduciary duty, and it's objective, right?
Because you think that they're not, right? You think that right now they're doing what?
Well, here's the issue. You got to look at there's asset managers putting together products that investors want, and they do want these ESG products. Let's be clear. Then you have the raters. There's a whole separate bucket of entities. The raters who are going out and saying this is ESG compliant, this is not. And then you have the issuers.
When you say raters.
Raters.
Raters, not like corporate raters.
No, raters.
Rater, R-A-T-E-R-S.
Yeah, okay,
So the raters that are going and saying,
this
is...
Not Carl Icahn.
Not Carl Icahn.
The raters.
No, I don't think he's into ESG, as far as I know. Yes, exactly.
Okay.
So there's a body of raters, including, by the way, the proxy advisory firms who are getting into this space, that are bringing the pressure to bear on the companies. Right? And that's where the rub is. Here's
the thing.
How do you get that rating?
So I just saw the ESG fund, $18 billion. What's BlackRock at? $7 trillion. Anyway, $18 billion. But should they be sold as giving you an advantage in performance and what you get out of it? Or should they be sold because this is something that you want to support because it's important to you? Whatever your values are.
I think the latter, and I worry about the former. The former is...
The former, I don't think you can sell that. And the latter is fine. It's like, I've always said, like water.org. They lend out, you can go into a micro loan program and give you money. and you might get it back. And if they do really well, you might get 1 or 2%.
Right.
That's fine. I would do that. I would do that, and maybe I get my principal back. Hopefully I do, but I get 2%. But to go in thinking that you found some magic elixir for better returns based on what could or could not be, rational.
It's econometrics, right? This is what worries me. And Andrew knows we had this debate about staggered boards in the past, right? All these studies said destaggering boards was a good thing. Well, guess what? A whole bunch of other studies came out and said it's a bad thing.
What happens if the funds just said, look, we don't know if we're going to actually get better performance? And this goes to the issue of you just decide we don't know if we're getting better performance or not.
Right.
But we do know that this is what you get to invest in.
Yeah.
Is that
That's
okay?
a perfectly fair disclosure. Absolutely.
So what happens if it just has a line at the top that says we don't know if there's going to be an improved economic performance, but we do have this view about what is
my guess is that there's a lot of that in there already with these disclosures. Now, remember, again, the issue, though, is on the companies. Right? Are the companies getting pressed to pursue these ESG
When you say companies,
measures?
You're talking about the
underlying
company
in
that's
funds.
in these funds.
Absolutely. And that pressure being brought to bear.
I think that's where it does get more problematic.
Right? Because this
some
is
of
the
it
whole
might be, the pressures may be, antithetical to shareholder returns.
Yeah, I think
Well,
this
let me ask you a
emphasis.
question. So Apple, I believe in the United States, is now, I don't know if they're not fully renewable, but I think they're pretty close, if not completely renewable energy. I mean, like, that's their goal.
Okay.
Is that a good thing or a bad thing?
Well, they've made a decision.
They've made a decision.
Yeah, their board
to do that.
and management has made a decision that that's in the best interest
in
of
the best
company.
interest of the company.
That
and
should
maybe
be second guessed. Yeah.
So you're saying that should be second guessed, or
no, it shouldn't be. If they've arrived at that decision on their own and they've decided that this is the best thing. But
let's say they feel like they're under a little bit of pressure. I mean, I don't think they feel this way, but let's say they felt some pressure from an ISS or some organization on the outside, or think to themselves, you know what? If we do this, we might actually get in this other cool ETF that actually might help us.
But they don't get to say, like you said with the asset managers, this might actually not be the best performance for us. We're going to pursue this, but it might not be the best return to shareholders. That's not consistent with their duty.
This has nothing to do with this. Private equity firms in the past year or two have moved from partnerships to C corps, right? Or I may be getting that right or wrong.
Sounds right.
But they changed their structure. Why did they change their structure? Because they wanted to be eligible for some of the big index funds that they weren't eligible for before. That may or may not be good for their day-to-day management.
But automatically, you get more dollars
Absolutely.
and more investors who can look at you.
Yep.
Right. But the question is, I assume there are going to be companies that are going to say, I want to do X on the ESG front because I think there's going to be more dollars available to me.
Yeah, but the question is there a backlash? Do you alienate somebody like Joe or somebody else who looks at it and says, that's not ESG?
You do.
Like, that's
ridiculous.
ridiculous.
I mean, this is, and to me, again, the asset management issue is interesting.
Yeah.
But the issue where, being rated piece of this is where the real tension
I mean,
lies.
I could see all kinds of issues. I mean, the defense contractors, in addition to making weapons that kill people, they make Patriot missiles. They also do space research, and we want to have the Space Force. Do you think? So you could have a whole movement based on some of these employees out in Silicon Valley not wanting their companies to do any business with defense contractors. Then that moves to ESG funds that have no companies that do that have anything to do with defense. And then suddenly you got this ridiculous, misguided, woke notion of that you're doing something right, and it's absolutely detrimental to the country and the society.
And it's all theoretical until proxy season, when you're getting graded by.
God, I don't want someone deciding what is woke and what isn't for me.
Yeah.
But you should just buy the regular index.
I'm talking about companies too, and pressure on companies to be, and we're going that way.
And this proxy season, I'll tell you, will be the most real pressure, I think, brought down on companies. You got ISS.
But you know what? At least with companies, you can vote with your feet. If they're going down this ridiculous woke path, you can just say, you know what, I'm out, and I'm not going to own the stock. And then people like you can load up on this. Well, we can, if we could. Anyway.